An interest rate swap is a financial contract between two parties to exchange interest payments on a loan or investment. It's commonly used by businesses, financial institutions, and investors to manage interest rate risk or reduce borrowing costs. What is an interest rate swap? An interest rate swap is an agreement where two parties exchange one type of interest payment for another. Typically, one party pays a fixed interest rate, while the other pays a floating interest rate based on a benchmark, like the LIBOR or SOFR. This swap doesn't involve exchanging the loan principal. It's purely an exchange of interest payments. How does an interest rate swap work? Two parties agree to swap interest payments. Party A has a loan with a floating interest rate and wants to switch to a fixed rate for stability. Party B prefers a floating rate because they expect rates to decrease. Exchange of payments. Party A pays Party B a fixed rate. Party B pays Party A floating rate based on a benchmark. Example: Party A pays a fixed 3%. Party B pays a floating rate, e.g., LIBOR plus 1%. If LIBOR is 2%, Party A pays 3%. Payments are netted, so only the difference is exchanged. Why use interest rate swaps? Manage interest rate risk. Companies can switch from floating to fixed rates to avoid rising interest costs. Lower borrowing costs. Swaps can reduce the overall cost of debt, depending on market conditions. Flexibility. Companies can customize swaps to fit their specific financial needs. Types of interest rate swaps. Fixed for floating. One party pays a fixed rate, and the other pays a floating rate. Floating for floating. Both parties exchange floating rates tied to different benchmarks. Fixed for fixed. Both parties exchange fixed rates in different currencies. Real-life example. A company with a $10 million floating rate loan fears interest rates will rise. They enter a swap to pay a fixed 3% rate while receiving a floating rate tied to LIBOR. If LIBOR rises above 3%, the company is protected and pays the fixed rate instead of the higher floating rate. Risks of interest rate swaps. Market risk. If interest rates move unexpectedly, the swap could become unfavorable. Counterparty risk. The other party in the swap may default on their obligation. Complexity. Swaps can be difficult to understand and manage for inexperienced users. Quick recap. What is it? An interest rate swap is a contract where parties exchange interest payments, often swapping fixed and floating rates. Why use it? To manage interest rate risk, stabilize cash flows, or reduce borrowing costs. How does it work? One party pays a fixed rate while the other pays a floating rate based on a benchmark. Risks: market fluctuations, counterparty defaults, and complexity. Interest rate swaps are valuable tools for managing financial risk, offering flexibility and stability in uncertain interest rate environments. However, understanding the risks and mechanics is key to using them effectively.